Welcome to Get Rich Education. I'm your host, Keith Weinhold. Mutual fund returns and 401ks are failing people due to inflation, emotion, taxes, fees, and volatility. Your investor psychology plays a substantial role in investing. Facts don't change people's minds. We're going to discuss what does today on Get Rich Education. MC Laubscher is the host of the Cash Flow Ninja podcast and president of Producers Wealth. He is on a mission to help you achieve financial independence and freedom as soon as possible. He achieves this by integrating the infinite banking concept with real estate investments to increase your returns and recapture cash flow that you are not even aware of that you're losing. MC shares the number one strategy of investors in his holistic wealth creation course at yourownbankingsystem.com.
Learn the easiest way to create wealth and passive income with real estate. Now you can access the best deals without the stress or hassle of having to find, renovate, or manage those investment properties. Norada Real Estate saves you time by providing you with passive income investment properties in some of the best U.S. markets. Learn more at PassiveRealEstateInvesting.com and download your free copy of the Ultimate Guide to Passive Real Estate Investing. There's no obligation and nothing to buy. Simply visit PassiveRealEstateInvesting.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Hey, you're inside Get Rich Education. Welcome into episode 242. I'm your host. My name's Keith Weinhold. Why don't stocks and mutual funds provide the types of returns that you think that you're getting? It is primarily due to inflation, emotion, taxes, fees, and volatility. In fact, the results of research done by Dalbar, published this year, 2019, consistently show that the average investor earns below average returns. For the 20 years ending December 31st, 2015, the S&P 500 index averaged 9.9% per year for a return, a somewhat attractive appearing historical return, but the average equity fund investor, they only earned a market return of 5.2%. That's due to a few factors. Largely, it's due to emotion. Now, a lot of people rely primarily on 401ks for retirement, like they're seriously thinking that that is going to be enough. Well, it isn't. It's not working. 8 out of 10 people can't retire when they want to. In fact, do you want to hear what the Americans' average 401k balance is by 10-year age group? Let's take a look at this. This is sad, but if nothing else, it might make you feel better. If you're in your 20s, the average 401k balance is $11,600. If you're in your 30s, so age 30 to 39, the average 401k balance is $43,600. If you're in your 40s, the average 401k balance for an American is $106,200. If you're in your 50s, the average 401k balance is $179,100. And in your 60s, $198,600. Now, I was actually kind right there by stating the average. I'm actually making it look rosier than I could have, because in every one of those age groups, the median value of a 401k balance is just 1/3 to 1/2 of those figures. 1 in 3 Americans have less than $5,000 saved for retirement. You heard me correctly there. That might be an income and savings problem, but the low 401k balances for each group that I mentioned involves more of this component of poor investment returns, like I mentioned. And this is all more important than it's ever been because there are longer life expectancies today. Life expectancy is 79 in the United States, 81 in the UK, it's 84 in Japan, so your money has also got to last longer. So with the Dalbar data, people who think that they're getting about a 10% return are really getting 5%, and that's before inflation is accounted for. I'm not sure whether fees are deducted there or not, such that the real ROI is often around 0. The problem is that the human reaction to good stock market news or bad news is really to overreact. This emotional reaction causes illogical investment decisions, and this tendency to overreact, that can become even greater during times of personal uncertainty. For example, that might be when the economy is bad or when you're nearing retirement age. There is an entire field of study which researches this tendency to make illogical financial decisions. It is called behavioral finance. The study of behavioral finance documents and labels our money-losing mind tricks with these terms like recency bias and overconfidence. So how does this really work when you mix your mind with your numbers, when psychology meets fact? Well, a time like recently when the stock market has gone steadily higher, people have a tendency to want to buy and buy more and buy more. Some people try to validate this act of buying equities at higher and ever higher share prices by telling themselves and telling others that, well, see, I'm a momentum investor. Well, that sounds good. That might even sound happening. And yeah, that's why I'm doing it. That's what they say. That's what they might even be telling themselves. And if during an up stock market, you had been holding out and you've been holding some dollars parked on the sidelines, but you do see that the market keeps going up, and you continue to get bathed in this media bath of positive articles about lofty share prices and strong quarterly earnings reports, or maybe that earnings reports don't even matter, and you also have friends that invest in mutual funds, pretty soon with these dollars that you've been holding on the sidelines, you begin to experience emotion, FOMO, fear of missing out. So you release those dollars off the sidelines into a bloated market, maybe even justifying in your own psychology that you're a momentum investor. Well, what you did is you just bought high. When you buy high, it's typically a shorter matter of time until the market turns. Other people soon want to sell their stock because they want to lock in their profit. That's part of the psychology of the turnaround. Others are locking in their profit. Well, after it's crested over the top and a market loses 10%, that's known as a correction. And people that held on and suffered the 10% haircut might even try to make themselves feel better and say things like, well, corrections are good, valuations were becoming stretched. But lofty stock markets rarely become overvalued by only 10%. Sometimes they fall 20% from their highs. That's the definition of a bear stock market now. And soon, more and more people begin to sell because they want to cut their losses and lock in some profits if they still can. If you've been holding on all this time, now you see hanging in there is increasingly difficult. Say the market has now lost more than 30%. Hey, in 2008, the stock market lost between 38 and 39% just in that 1 year alone. This is becoming increasingly difficult for the investor that stays the course. If you stayed the course here, you've only got about 60 cents left of every dollar that you had invested at the top of the market, and the pain begins to hurt. The bleeding hurts. Now you're steeped in this media bath of negativity with the articles that you read and the videos that you see, and this culminates in a feeling, an emotion of discouragement. You're so discouraged, and there's one way to finally stop this negative emotion that you're feeling, and that is to sell your stocks and move it into something like a money market fund, because you're just so tired of the uncertainty and you're so discouraged. So you sell because you found that's the only way that you can gain clarity and certainty again. You're so tired of being beaten up that you accept a 2% money market return, but worse, you accept selling for 40% less than what you bought for, and you validate this because you can just stop worrying. Well, now you've both bought stocks high and sold stocks low, and that's what so many people do. Even people know that they're not supposed to do it, but emotion within this school of behavioral finance is how emotion and volatility do people in. Oppositely, what happens when you buy real estate for cash flow and we go through a down market? Well, I told you what happened to me when I bought a fourplex in 2007 for $530,000, and 2 years later it was only worth $480,000. That didn't feel good at the time. It had lost value. It felt like the real estate market was imploding back then, and first-time homebuyers couldn't even get a loan. Well, that means they had to go become my renter, so my monthly cash flow went up substantially, even though my building was temporarily worth $50K less in value. So why didn't I get discouraged and sell my real estate at a market bottom like how a stock investor did in our example there? It's because a stock and mutual fund investor doesn't have substantial cash flow typically. I had substantial cash flow from that fourplex. See, cash flow helped me remove emotion, and that's the point. When you don't chiefly invest for a capital gain and you invest for cash flow instead, now you can understand how an income stream helps you avoid giving in to emotion. And that's where so many people lose, even when they think they're not going to lose. So when you tell people that their real return in their 401k is probably close to zero, this is a substantial part of the reason why. And we're going to talk about this more with a really terrific guest shortly.
What you talking about, Willis?
Yes, that could be a typical reaction about the long-term ROI being about 0% from mutual funds. I am in Portland, Oregon today. I just landed here a few hours ago, coming in from Guatemala City, Guatemala, here on this Memorial Day in the USA. Last week, we discussed 1031 tax-deferred exchanges here on the show. If that got some new thoughts percolating inside your head and you've ever wanted a free audio guide on 1031s, you might have that guide in your pocket right now, because you remember that I made an even deeper dive on the tax-deferred exchange in Get Rich Education, episode 143. Pretty much an audio guide on the exchange there in number 143. Let's chat with our guest, who's one of the top financial speakers anywhere, about mutual fund returns and more right after this. Finally, Total Control Financial gives you checkbook control of your 401k and IRA money to invest in real estate. It's time to get your retirement money into your own checking account, but you've got to avoid the little-known tax that you'll pay with any self-directed IRA. Instead, it's time for the QRP. Learn more and get your free copy of the QRP book by text messaging QRP in all capital letters to 72,000. For a real estate investor like you seeking an income property loan, go to Ridge Lending Group, NMLS 42056. Over the years, you've heard President Chaley Ridge generously devote her time to you here on the show as a guest. Ridge provides investment property loans in most U.S. states, and you're going to find out how they've helped more people realize their dreams of real estate financial freedom than any other mortgage lender in the entire nation when you get started at ridgelendinggroup.com.
This is Paradigm Life's Patrick Donahoe. Listen to Get Rich Education with Keith Weinhold and don't quit your daydream.
Today's guest is the founder of Wealth Factory. He's a New York Times best-selling author, and he's personally helped countless business owners and people just like you create efficient wealth strategies that fit their unique strengths. Welcome back to Get Rich Education, Garrett Gunderson.
Keith, 3 times, man. I've been on 3 times. I feel honored. Feel good about that. I must be sharing something of value because I know how you roll.
Indeed, a 3X guest. Yeah, an exclusive club. Well, Garrett, you often have very interesting ways of phrasing things. I think you and I think very much the same. Oftentimes, I state that financially free beats debt-free, and I back that up. But you have a way of differentiating financial freedom and economic independence. Tell us about that.
I love financially free beats debt free, by the way. That's killer.
Yeah.
And semantics matter because all wealth is built through conversation and language. So sometimes people say, oh, that's just semantics, or talk is cheap. Cheap talk is cheap. The words we use and the meanings they have convey everything from emotion and action. So financial freedom to me is when money is no longer the primary reason or excuse why we would do or not do something. So it's still a consideration. It's not the primary consideration. Most people is the only consideration. So if we break that down, there's 3 measures of worth. The first one is price. That's what we pay. That's the price tag. Most of the world kind of stops there. That's what they think about. The second measure of worth, though, is cost. That takes into consideration the net impact or the net effect or economics of the deal, right? Like you can have something that's a high price but a low cost, like an amazing CPA. Might be twice as much as anyone else, but save you 10 times more than anyone else. Well, that would be well worth the higher price because you still end up with more money in your pocket. That's kind of like the investor mentality.
Right.
The third measure of worth, I feel, is like the biggest differentiator. It's value. And value is simply perspective. It's our sense of fulfillment. It's what we enjoy. It's why we like it, right? That's value. And people that are financially free begin with value first, cost second, and price third. People that are financially, enslaved or in bondage, they only think about price, and that rules and governs their life. Can they get it cheaper? Can they spend all the time cutting coupons or looking at 100 different venues to figure out which one will be the lowest price, not taking into consideration the value of their time? Investors think about the value of their time. Entrepreneurs think about the value of their time. People that are focused on quality of life consider that time a major part of the cost. So that's financial freedom, where economic independence is a place where we have assets or businesses that create enough cash flow to cover our life's basic expenses. Financial freedom, state of mind. Economic independence, a state of finance where there's enough cash flow coming in to cover what we need to make it day to day. It's kind of a foundational place in our life. And so I like for people to emphasize both. You can have financial freedom in an instant, right? Through a lesson, through an insight, through an aha. Economic independence, that might take a little bit more time, but we've actually uncovered, maybe even discovered a framework where people can get there between 3 years and 7 years. Now, some weirdos get there a little bit faster than that, and I'm jealous of them, to be candid. But ultimately, it's a 3 to 7 year journey, not a 30-year journey, not sacrificing and scrimping and budgeting your way there. It's simply knowing the right information to leverage and using that leverage to your advantage. And you don't have to leverage a single dollar. It's leverage of knowledge, which is some of the most powerful leverage out there.
Yeah, I think poorer mindsets often ask what their money's worth and what their money can do for them or what their money can save them from. And the more abundant mentality is asking that question, what's my time worth? And absolutely words matter. All the Get Rich Education podcast has ever been from the beginning is words, but words do matter. And yeah, I love you articulating the difference between financial freedom and economic independence. Tell us more about the 3 to 7 year journey. Certainly we're thinking about building cash flow streams in that time, but oftentimes we use leverage here to help amplify wealth. Oftentimes real estate investors can do that at a 4-to-1 or a 5-to-1 leverage ratio. So tell us more about leverage, cash flow, arbitrage, and some of those ingredients that go into a 3 to 7 year journey toward, is it economic independence or financial freedom?
Economic independence, 3 to 7 years. It might be 3 to 7 minutes for financial freedom. Who knows? You just got to have the right mindset, right? And mindset's something that it can happen in an instant or it could take a lifetime. It really depends on how people operate, what they're committed to, and what awareness they have. But economic independence is 5 levers to get there. The first one is to recover cash. It's how do you keep a lot more of what you make without cutting back? See, that whole notion of living within your means for too many people becomes about budgeting, but that sucks. There's 2 other ways to live within your means. One, be a lot more efficient within your means to keep more of what you make. Or the next thing is you could expand your means. But let's start with being more efficient. The 4 main I's, if we're using kind of American terminology here, to efficiency is the IRS. Most business owners overpay them, so get that money back. Interest. If you haven't reallocated, renegotiated, or restructured, you can put money back in your pocket simply by doing that properly. The third is investments. There's a lot of hidden fees and commissions. There's a lack of downside protection. There's a lot of transfer of wealth due to ignorance. But ultimately, there's just things that are slipping through the cracks that can be put back into people's lives. And the 4th I is insurance. A lot of duplicate coverages, improper structure. So we begin with you keeping more of what you make, not through budgeting, but through efficiency. The second lever is to engineer wealth. Figure out what is your economic independence number and reverse engineer and say, what steps are going to get you there the fastest? On previous interview, we talked about cash flow index and investment index. Once you understand those concepts, you know which things to tackle first. Then the third lever is to accelerate investment income. This is all about becoming a cash flow investor. You have stagnant, lazy resources that you could turn on a cash flow tap and start improving your cash flow. A 72T in a retirement plan allows you to get to it before 59 and a half and start creating cash flow today. Stop reinvesting and compounding your interest because compounded interest equals compounded tax and start creating cash flow with that interest so you can create velocity and multiple assets. Or the 4th lever is to scale business revenue. If you have a side hustle or whether you have a business, there's certain things you can do to get exponential growth. That exponential growth comes from letting go of the lesser things and delegating those and embracing the things that only you could do that create the most value in this world. That's where we get that scaling business revenue. And that's a huge game changer. And the 5th one is treating yourself as the greatest asset. And that's to make it count. having something other than money as your scorecard, relaxation, rejuvenation, and recreation, so you show up in the world as the best version of who you are. Now, I could drill down in any of those 5 levers, but recover cash, engineer wealth, accelerate investment income, scale business revenue, and then make it count. Those are the keys.
Why don't you drill down on one of those, Garrett?
Let's just drill down on scaling business revenue for a second. A couple quick things on scaling business revenue. That's the 4th lever. If you're trying to scale a building and you put a ladder against it, you don't American Ninja Warrior that building and then have both of your hands on the rung and try to flip the rung up. You let go of one rung before you grab the next one. So let go of the things that you're not the best at, or that drain your energy, or that someone else can do, to free up your time to do what only you can do, right? So you can let go before you grow. So what one thing can you give up today to do more of what only you can do that could increase your productivity? The second thing is you got to have amazing people around you so you could delegate roles, ROLE, roles to them that they own, so you don't have to micromanage, and that frees up your time. I want to be a speaker, a content creator, and a writer. If I'm involved in sales and operations, or if I'm involved in administration, that's not the best rung for me. I have to let go of those things fully and then embrace the things that are going to bring that highest leverage. So those are just a couple examples of scaling business revenue. We could go for days on that, but that's a huge opportunity for people to exponentially grow wealth. Like maybe just take money that's going into other investments and say, could you add the right people to your team, the right processes to allow them to perform better, or the right technology through some procedural way that doesn't require human interaction day to day? And if you take that and invest into yourself and into your business, can you get a higher return than in some stinking mutual fund or some other company you know nothing about, or some other investment that you heard about because you were at a cocktail party versus the very thing that you have the most control over?
It's about the Pareto principle, doing those 20% of activities that give you 80% of those results. So it's about you having the ability to outsource and automate those things to other people. You mentioned mutual funds, denigrating them somewhat, and I have as well. You talk about compound interest. I think compound interest really gets a lot of attention from people, and I don't know if it's warranted. Now, I actually think compound interest, say 8 to 10% return per year, compounded year after year, that looks pretty great when it's charted out. But a lot of times compound interest for an investor just really doesn't translate to reality when you consider the deleterious effects on mutual fund returns of inflation and emotion and taxes and fees and volatility. A lot of people just aren't thinking about those things, so they're not getting nearly the return that they think they are for their mutual funds. Tell us about that.
Yeah, let's break this down a little bit. First problem with the mutual fund is that they have certain designations like a growth fund. And even if the fund manager knows it's not a time to be in growth stocks, they are hamstrung. They have to keep it in growth stocks, and you're going to have a decrease in value. Now, you'll have the people that are out there preaching diversified, low-cost portfolios in an index fund, and over the long haul, it's going to work out. Well, the reality is it doesn't really work that way. Part of the problem is average versus actual returns. See, an average return of 7% or 10% may not be anything close to the actual return. See, if I have 10 grand and I lose 10%, I'm down to 9 grand. Now, if I get 10% back when I turn on the news and they say, we've rallied, it's back, we're 10% up, you're only at 9,900. You're not back to the 10,000 plus. They didn't forfeit the fees or waive the fees during that time. Right. Plus, you lost the time value of money. But here, let's get to the more deceptive pieces of the mutual fund. The more deceptive pieces is even if you're going with the low-cost leader index fund that has almost no fees against it, because we know how detrimental fees are if the fund manager isn't actually performing, and majority of them don't outperform the efficient market, so to speak. So here's the problem. We are now in a time where technology is moving so rapidly. And we've seen companies, overtake very quickly transportation, or hotels and lodging without even having a fleet of cars or without even having a bunch of hotels because of technology. And so what worked in the past doesn't work anymore. And there's someone right now in the basement of their house or their garage or working in their boxers somewhere that's going to invent something that will disrupt in the next 7 years some of these major Fortune 500 companies that could actually render them not even valuable whatsoever, basically render them useless, right? Now, the problem with that is if I'm in an index fund and I have 500 companies that spread across and one of those companies is out of business, that's a 0% for that one 500th of that money forevermore. But what they'll do is they'll replace that company with another company. And then another company might be a more up-and-coming company. It might have more room for growth because they're not worth $1 trillion yet. And it's going to look like that S&P 500 index fund did really well the next future 12 months. But what they're not accounting for is I didn't have that company. I had the companies I bought before, and one of those companies is now completely out of business. So how many more of those companies are going to go out of business in the future and not show up on my actual return, on my average return, but actually impact me? That's a problem. And I think that with technology, we're going to see a lot more of this because companies move slow. Hard for them to fire a bunch of people overnight without a bunch of blowback. They're taking money from the government, and with that money, they have a lot of strings attached, which might hamper their innovation and creativity and their maneuverability. And so I feel like we're in a time where we're going to see more happen in the next 10 years than in the history of the stock market. More companies get so disrupted because of how fast things move and how we don't have to become part of some family to get money or have to have all of the luck in the world or have all the capital that we can raise. There's people that are using methodologies I'm teaching in my new book, Win Then Play, that they profit right up front, where they create the momentum immediately, where they don't have to have physical offices and they don't have to have this massive infrastructure and they don't have to have all this time to go raise funds, because the way they raise funds are for people that are clients and customers that actually support the organizations. So that is a scary notion for people that are just buying, holding, and praying. That when I take the year 2000 all the way through 2014, that we saw an 8.7% total gain adjusted for inflation in the market, not year by year, total gain, right? Then we saw a few good years and it felt really nice. And then we saw that gain wiped out with one negative year. So when those negatives happen, it's a transfer of wealth that goes into someone else's hands, even though we say it's a loss. And the reality is someone else ends up with the money that sold it to us, or because they did an option and one person thought it was going up, the other person thought it was going down, or there's flash trading that's constantly siphoning money out of our pocket with their ongoing trades with supercomputers. It is a horrendous place for people to be, because even if we eliminate the fees through index funds, it's hard to eliminate the volatility. We're now in companies that may not exist in the near future, and that ends up zeroing out that part of the account, although the averages don't show it. And we see that volatility having an impact not only from time value of money, but it takes longer for that to actually get back to where it started from, because there's less that's earning money. And even worse, if we're going to so-called retire and try to take money out of it, there's new reports saying if you take more than 1.25% from a volatile stock account, it has almost no chance of making it past 20 years because of double-digit losses or 2 years in a row where you have negative returns. So I'm getting a little bit passionate about this because I think we're overly reliant upon a market that's let us down far too long, because investing has become far too synonymous with the stock market. And there's so many voices and so many books and so much information out there of buy, hold, and pray, dollar cost average. You're in it for the long haul, and it's a failed experiment that there's not enough marketing and information to say just how bad it's failed the American public. But 401ks aren't even close to what they were supposed to be. People are not going to be able to retire off of these things. They're not going to be able to buy a hamburger in the future if they keep at this anemic rate. We've seen companies go completely bankrupt because they couldn't handle their pensions. And their pensions were only a so-called conservative 8% return they were hoping to get, and they thought the market was going to do 10. But guess what? People had to get money along the way, which did something called disinvesting and all these other things that we've talked about here. So look no further than every company that offered a pension, and the pension either bankrupted the company or they had to eliminate the pension to stay alive. We've seen the market be so heavily disappointing because it doesn't make sense for companies to being bought for 70 times more than the actual numbers say they're worth, simply because it's hyped up. So if you don't understand how you're going to benefit, if it gives you cash flow today, who the fund manager is, what your exit strategy is, why it might go down, how you can protect the downside, let's just call it what it is. We're not investing anymore. We're gambling. Now, that's my soapbox, Keith. I know I went off for a little while there.
Oh, you're bringing up so many good points about the downsides of mutual funds that, is there really any way for a consumer, if you want to call them an investor in this case, in a mutual fund, is there really any way for them to know what their true ROI is after adjusting for all these factors? Can that even be discovered?
It's hard enough for me to know everything going on in my own company right now. That's one company, let alone we put 500 companies. I can't predict everything that's going to happen in the future because it's happening at a totally different pace than it was ever happening before. Some of these companies, they lose a money manager and it's still called the same fund. Like you and I could just pick this thing apart left and right, yet somehow people still feel comfortable putting their money there, even when there's major downturns like 2000 to 2002, 2008 to 2010, 2018 to however much longer it decides to keep being this volatile and this problematic. And I just don't want to put my future and my dreams and my lifestyle in the hands of something I know nothing about, I don't really control in any way, shape, or form, because everyone's showing really nice mountain charts or saying that it's averaged 10% since 2000 BC. I don't care what it's averaged in the past because averages don't matter. I want to know what's the bottom line. I want to know what I can count on. And I just don't think there's a lot to count on there. I have $0 in the stock market. The last time I had money in the stock market was in early 2000. Cashed it out. The only stock I'm concerned with is my own businesses. I have a bunch of overfunded cash value that I utilize, I can tap into. That earns 4 or 5%. I'm not thinking that that's a great return. I just know I can use it when the right investments come up. I bought companies with it. I bought real estate with it. I paid off high interest rate loans with it. I launched my book with it. Like, I just have a storage tank that's earning a lot better than savings accounts. And I rely zero on the stock market. Actually, the worse the stock market does, the better my business does, because people start paying attention instead of going, well, we just had 4 good years. Right, that could be wiped out in 1 year. And by the way, they are not going to refund the fees they took from you. They're going to just tell you to work longer. And you brought up a great point, which is compound interest looks crappy in the first 10 years. It only looks good over 30 years. But it doesn't look nearly as good when you throw in some losses over time in that thing. It totally decimates the entire notion of it.
Yeah, and that's remarkable that you've been completely out of the stock market since the year 2000. That's better than me. I've been completely out of the stock market since the year 2014. I think for most people to be invested in the stock market, and that might be mutual funds in the retirement account, that's just what everyone else does. So it feels safe. And there's no way I could be wrong doing this. And a lot of people think there's no way they could be wrong investing in mutual funds with a retirement account, because that's all they've ever known. And when you believe in something for so long, it's difficult to change and stop believing that thing, even if it's wrong, just merely because everyone else is doing it and you've believed that same old thing for so long.
That's why I had to write Killing Sacred Cows, because it's not the obvious lies that are hard for us. It's the subtle ones. And when there's enough evidence of saying, oh, this is fine, and enough people are doing it, then I really like what Thucydides said. He said, if 50 million people say a foolish thing, it's still a foolish thing. If 50 million people do a foolish thing, it's still a foolish thing, right? And so John F. Kennedy talks about when we view the world through the eyes of the myth, we look for evidence to support that myth. And when the rest of the world is caught up in that same myth, and let's just figure out, why is it that this is so prevalent? It's partially so prevalent because there's a lie that we're getting tax savings by putting money in retirement plans. It's not, it's tax deferral. That's very different than tax savings. And if we're a bank or financial institution or mutual fund, what do we want from people, Keith? What are these mutual fund companies wanting from people?
They want them to tie up their money with them as long as they possibly can.
Nailed it, right? They want their money on an ongoing basis. They want to hold on to it for as long as possible and give back the least possible. That's how they make money. And when they tell us it takes money to make money, what they're not telling us is it doesn't take their money to make money. It's taking our money that they're getting a fee on, regardless of whether we earn or not, for them to make money. That's problematic. So if I were to even have money in the stock market, I was listening to a podcast with Phil Town recently. I like his philosophy on individual stocks. If I was wanting to be completely mindless, which I don't, I might consider an index fund, but even that I'm uncomfortable with because of everything we talked about here today.
Yeah.
I think that most of America would be better off just stashing this in their, under their mattress, rather than being in the greed and fear and up and down and pull it out at the wrong time, get in at the wrong time, have fees coming out all throughout it, having inflation starting to decimate it. Like, it's not a world where we get to choose to be completely passive. If you're going to be passive with your money, it's going to pass you by. It's time to take a little bit of responsibility. You don't have to know everything. Get good at a few things. That's it. Get good at a few things. And if you're not going to do that, then just stash it away in cash flow banking. Our cashflowbanking.com site is super useful, of a good place to store money if you're going to be relatively mindless about it. But I think the more we try to delegate life, like, I wish I could delegate working out. A lot of times I can't. I wish I could delegate, if I'm ever camping, someone going to the bathroom for me. I can't. You can't delegate your legacy. You can't delegate all the responsibility around your money. We have to be stewards over it. And I love that people are listening to this because they're taking that initiative. They're facing and having the courage to look at their money and say, how does this really work? It didn't come with an instruction manual, but if you're willing to just figure a few pieces out, you're going to be so much further ahead. Become economically independent. Pay yourself first. Build up enough liquidity. Focus on cash flow. Only get good at a few things in investing rather than try to get good at everything. And then really dial that in and focus instead of diversify. That's the roadmap.
The masses want to do whatever fuels their confirmation bias. And I think that happens because to most people, it is more comforting to be affirmed than it is to get informed. So, Garrett, you've got a lot of great resources out there. Let our audience know how they can learn more about you.
Well, cashflowbanking.com is a great website on some of the resources we talked about, or wealthfactory.com. Those are probably the two best things that people can go check out. Or wealthfactory.com/podcast has my books like Killing Sacred Cows, What Would the Rockefellers Do? And you don't have to buy them from me. I'm giving them because I want to see 1 million people liberated. I want to see 1 million people become economically independent. And if that resonates with you and things look great, then maybe we can have a longer term relationship and do something. But I'm going to contribute first. I'll make the first deposit. You just have to commit to at least reading a page if you get any of these resources.
Garrett, it's been great having you here. It's always insightful. Thanks for bringing the passion and being back on the show.
Hey, thanks for having me, Keith.
Oh, great stuff from Garrett, as always. When it comes to investor psychology and a lot of other things in your life and people that you see every week, you know something? Facts don't change people's minds. Did you ever realize that? Yes, facts don't change people's minds. You and I as well tend to undervalue evidence that contradicts your beliefs, and you overvalue evidence that confirms them. People filter out inconvenient truths and arguments on the opposing side, and as a result, our opinions calcify, and it becomes increasingly harder to disrupt established patterns of thinking. If you have any doubts about the power of the confirmation bias, think back to the last time you Googled a question. Did you meticulously read each link to get a broad, objective picture, or did you simply skim through the links looking for the page that confirms what you already believed to be true? And let's face it, you'll almost always find that page, especially if you're willing to click through to page 9 on the Google search results. It's easy to assume that drowning another person with facts is the best way to prove that mutual funds give lousy returns, or that climate change is real, or that the war on drugs has failed, but that's not really true. Look, people are reluctant to acknowledge mistakes. We all are. To avoid admitting we were wrong, we will twist ourselves into all kinds of ridiculous, contortive positions. The key is to trick the mind by giving it an excuse. If you can convince your own mind or your friend that your prior decision or prior belief was the right one, given what they knew, but now that the underlying facts have changed, then so should the mind. But instead of giving the mind an out, instead, people often do the wrong thing and they go for a punch to the gut, belittling the other person, saying, "I told you so," or "what an idiot." I mean, telling someone face-to-face or on social media through a post that they're wrong, all that does is that activates the other person's defenses and that solidifies their positions. This is why facts don't change people's minds. The moment that you belittle the mind for believing in something, well, now you've lost the battle. At that point, the mind will dig in rather than give in. Once you've equated someone's beliefs with idiocracy, changing that person's mind will require nothing short of an admission that they are unintelligent. And that right there is an admission that most minds are not willing to make. Showing a mutual fund investor's real ROI to a room full of portfolio managers, that is not a great approach. Just like playing Al Gore's Inconvenient Truth on repeat to a room full of Detroit auto workers will not change their mind on climate change if they're convinced that your agenda will put them out of a job. Humans operate on different frequencies. If someone disagrees with you, it's not because they're wrong and you're right. It's because they believe something that you don't believe. The challenge is to figure out what that thing is and then adjust your frequency. If employment is the primary concern of that Detroit auto worker, well, then showing him adorable images of endangered penguins or Antarctica's melting glaciers will get you absolutely nowhere. Instead, show him how renewable energy will provide job security to his grandchildren and now you might have his attention. This approach applies to real estate negotiation, or you making sales in business, or a lot of things beyond just investor psychology, because you just can't tell someone that they're wrong. People won't admit that. Facts do not help. See, when your beliefs are entwined with your identity, changing your mind means changing your identity, and that is a really hard sell. So a solution is to put a healthy separation between you and the products of you. A person can change their vocabulary to reflect this mental shift. At conferences, instead of you saying, in this paper, I argue, instead, you could begin to say, this paper argues. A subtle verbal tweak like that could trick your own mind into thinking that your arguments and you are not one in the same. You've kind of taken the pressure off yourself. Obviously, you're the one that came up with these arguments, but once they're out of your body, they take on a life of their own. They became separate, abstract objects that could be viewed with some objectivity, and it's no longer a personal thing. It can simply be a hypothesis that's been proven wrong. In fact, it was John Adams, yes, the second president of the United States, that John Adams, that said, facts are stubborn things, but our minds are even more stubborn. Well, that's the thing about listening to this show and shows like this. You can change your mind on something that you believed previously, and nobody would know. So this show allows you to save face, if you will. Well, thanks to the terrific Garrett Gunderson today. Today we discussed investor psychology and some softer skills. Next week, we're going to discuss some harder skills as we cover some of today's best apps and websites for real estate investors. You know, something that completely flatters me, and it's happened a few times lately, when new listeners to the show here tell me something like, as soon as I found this show, I had to go back and listen to every episode from the beginning. I am totally flattered with a comment like that. I am genuinely grateful for your listenership. I mean that in the most sincere way. If you get value from Get Rich Education, I would love it if you would take a screenshot of the episode here and post it on your favorite social platform, your Instagram, Facebook, Twitter, or LinkedIn. Until next week, when I'll be back to help you build your wealth, I'm Keith Weinhold. Though you might quit your day job, don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
Countless investors get killed on their long-term maintenance costs in their rental property portfolio, but that's far less likely when you buy brand new construction. Let me tell you about my friends at JWB Real Estate Capital in Jacksonville, Florida. They pioneered the build-to-rent model that allows clients like you to invest in new construction, turnkey rental property. That's why JWB has been featured on the front page of the Wall Street Journal and other national media. If you want new construction rental properties in your portfolio, talk to JWB. Give them a call at 904-677-6777 or visit them at newconstructionturnkey.com. The preceding program was brought to you by your home for wealth building, GetRichEducation.com.